Hey guys, and welcome back to another episode. My name is Adam, and you are watching Unlimited Options Investing. In this video, we'll be taking a look at the S&P 500, the NASDAQ, crypto, and we'll also be taking a look at Tom Lee, who was on CNBC, and what he had to say regarding today being tax day and Uncle Sam getting paid. So we'll be taking a look at all of that. If this is your first time on the channel, welcome aboard and hit that subscribe button, smash that like button, and take a look at the description for links to my Instagram, my TikTok, and my Twitter. Check it out. So a pretty mixed day. The S&P 500 was pretty much flat on the day. We're seeing a ton of red in the middle here with healthcare, diagnostics, consumer defensive, industrials, beverages, railroads, restaurants, and utilities. We see green amongst energy and oil. Capital markets also green with Morgan Stanley and Goldman Sachs, even though Schwab was down 10% on the day. Banks looking pretty good. JP Morgan, Bank of America reporting on Monday, Wells Fargo, Citigroup. Semiconductors looking pretty green, Tesla, and then big tech. Amazon, Facebook, Google, Microsoft, and Apple all sideways. Taking a look at crypto, right where we left it last time. Both near their critical psychological supports, Bitcoin at 40,000 and Ethereum at 3,000. I know earlier on in the day, Ethereum was below 3,000 and Bitcoin below 40,000, but looking like Bitcoin has recovered a little bit more than Ethereum, near that $41,000 mark. And one thing I haven't talked about on the channel is margin statistics. Essentially, how much are people going in margin when it comes to their stock accounts? So we scroll down and take a look at January of 2021 at the height of the retail euphoria, GameStop AMC era, $798 billion, February $813 billion, and gradually increasing until we hit the end of the year where we peaked at $935 billion, November $918 billion, December $910, and then we hit this year when we started correcting and falling all the way down to $829 billion, $835, and then for March $799. So now essentially where we were in January of 2021. Alright, and taking a look at the candlesticks, the S&P 500, we had gap down when we opened today, lower than where we closed on Thursday. We went down a little bit, went back up, and then finished pretty much in the middle of nowhere. This is a nothing candle. We still have no direction until it gives us something. And the exact same thing when it comes to the NASDAQ. We gap down, trade a little bit up, a little bit down, and then until we get some kind of more information, until we get some kind of price action, we still don't know. Again, unless we break this 340 level with conviction, we're still in the middle of nowhere. If we want to see the first step of recovery, we want to break these moving averages. The real recovery comes when we break this 370 level with conviction. Alright, I also want to get into this video with Tom Lee, who was on CNBC's Overtime, talking about his stance on the market and why today being tax day.
Now to another headliner, Tom Lee, who says it's no surprise stocks are struggling recently and Uncle Sam is to blame. He joins me now at Post 9. So it's all Uncle Sam's fault, tax day, and then everything's going to be cool?
I hope things get better, but yes, this year, April 18th is tax day. It's an extraordinarily big tax hit. We calculated what we estimate Americans owed. It's about $828 billion. Excluding crypto. Crypto is probably another $125 billion in taxes owed. So about $1 trillion went to Uncle Sam today.
And so, but you think literally like you get today out of the way and then there's a noticeable and notable impact in the market?
Yes. We looked at years where the market was strong. The 2 weeks into tax day, our markets are weak. There were a lot of folks caught off guard because they thought they had until October, and of course they don't. They have April 18th. So there was a bit of a frantic push. And hopefully this takes away indiscriminate selling.
Okay. We have to discuss this tweet of yours where you agreed with somebody. And honestly, I saw this over the weekend. And I was like, what? I was like, what is Tom talking about? So I came into that. I was like, we got to get Tom Lee on. A gentleman by the name of John Carter tweets the following: the increasing shift out of financial assets into hard assets will soon turn into a panic move. And you said agree 100. And I'm like, wait a minute. Tom Lee comes on the show and he's bullish and he says the lows are in for the year, and now you agree 100 that there's going to be a panic move out of financial assets. I'll let you explain how that makes sense.
Yes. Well, because not all assets are equities. There's a lot of financial assets that are terrible inflation hedges. Americans today own $55 trillion worth of bonds. And they are going to get their quarterly statements. Bonds are down 7%. 25% of all 10-year periods since 1880, bonds have had a negative realized return.
How anyone could own bonds over the past couple of years, at least since I've gotten into the market, is beyond me. You're pretty much guaranteeing a loss when you buy bonds, at least in these macroeconomic conditions.
We're probably entering another decade. So there is going to be this, we believe, a panic out of bonds. It'll go into income generating real assets. And a big chunk we think will be TINA, which ends up in the stock market. So I don't think people are going to sell stocks to buy real assets, but they probably will sell a lot of bonds.
So you're talking specifically about the bond market and money coming out, because it doesn't say that. When I read this, I was like, what?
That's right. And I probably intentionally left it a little vague just because, it's the weekend. I was having a little fun.
Okay. You knew I was going to call you and be like, what in the world is this? In all seriousness, you do have people suggesting that there is an alternative, that TINA is no longer TINA, that maybe bonds are an alternative to stocks.
Yeah, I mean, it's getting to be very tricky now because we have inflation that is quite elevated. We don't know if it's going to cool. Hopefully, that's our base case, that it cools. And we know that bonds yields have moved to a level that people might want to actually own some bonds. But the reality is if rates do creep up, so we have positive real rates, meaning the 10-year goes towards 4 or 5, anybody who owns that $55 trillion bond complex is going to lose another 10%. So you're talking $5 trillion of realized losses if people don't rotate out of bonds.
What do you make of the fact that interest rates, they don't seem to want to go down right now? That sort of throws a wrench into your bullish thesis if rates continue to rise. It's one reason why the stock market seems to be having fits and starts, with all due respect, aside from Uncle Sam wanting his or her money.
Yeah, stocks have been tough. We still think February 24th is the low. I think there's a lot of fear in the equity markets towards the Fed. But I think one thing just for the viewers to be comfortable with is there's already been a huge adjustment in mortgages. And auto sales are already rolling over, and they're super sensitive to cost of financing. So I think a lot of the work that the Fed wanted to see is being done in the bond market. 10-year at 4% is still a 25 PE for a bond. So I think stocks can still have multiple expansion if rates move higher from here. But of course, 2.8, if we stay at 2.8 the rest of the year, I think stocks can rally pretty strong.
Bullish.
And I agree with that. I actually mentioned this in a past video regarding the 10-year yield. It's approaching an area it's found resistance over the past half decade at about 3%.
As we mentioned, sitting with Leisman as we speak, having this conversation in which he said Fed tightening is in the market. And that's been your sort of case for a while. Here's the conversation that is going on as we speak, and we've been bringing headlines because Bullard certainly likes to make them. Is it all in the market?
I think that there has been a lot of the work done by the markets on behalf of the Fed. So I think the Fed has been able to get long ends up. This curve is steepened. Cost of financing's up. We're already seeing some demand hit from higher gasoline. So if the Fed was worried about the S&P going up 10% a month, it hasn't been. And that's, I think, really helped make the Fed a lot more comfortable with where markets are. And I know Adam just previously was saying, and I kind of agree, I think that there's a chance that the Fed could actually make a dovish pivot towards the end of the year.
Man.
See, Tom's even referencing my name now. I again completely agree with him here. This correction and volatility we've been seeing since the start of 2022 has in a way made the Fed's job easier. It's not like we're currently at record highs and getting more and more detached from reality. The market has in a way done the Fed's job for them.
And I just don't get any feeling that anybody else is saying that but you, Adam Parker, and maybe 3 other people I could find on a street corner somewhere. I mean, where does that view come from?
Well, I think that over the weekend, actually, J.P. Morgan economists had a great study showing like the 4 types of inflationary items, things that are persistent and things that take, that are firming. A lot of these sort of things like auto sales, they're already starting to roll over, and they were huge contributors to CPI. So I think that if inflation on a headline basis is peaking or plateauing, the markets get more comfortable with that, and it takes a lot of the pressure off the Fed as well.
No, but when you look at food and energy, there's just no indication that it's backing off at all. I was talking with Adam, and I know you saw yourself today. If I pull it up, natural gas has gotten everybody's attention. It already had, and now you go over $8. I mean, doesn't that mean something?
Yes. I mean, energy, even though it's not directly part of, PCE, it is still works its way into inflation.
Yeah, it hits people in the bottom line, though. Tom,
Yeah.
Right? It affects consumer sentiment. They see natural gas. They see their bills going up. They're worried about where food and energy prices already are.
That's right. And I think one of the things that we have to see is if it does soften the consumer, that becomes a feedback loop that actually weakens inflation. And but you're right. I mean, the good news is in America, food is not even 9% of CPI. Unlike rest of the world where food is 40% of people's wallet.
I appreciate you coming down here and clarifying your tweet because it got me thinking, and thus we had to talk. That's
Yes.
Tom Lee of Fundstrat. We'll see you again soon. Up next, grain.
So that's Tom Lee and his perspective. Let me know in the comments below, do you agree with him or disagree? Otherwise, that is the end of my video. Thank you very much for watching. As always, don't forget to subscribe, hit that like button, and check out my description for my Instagram, my TikTok, and my Twitter. See you guys in the next video.